Anywhere else is not me. What makes this analysis different is simple. I do not follow the Western financial press cycle. I follow the capital that moves before London opens, before New York wakes up, and before the headlines tell you what already happened. Today's video is going to be uncomfortable for a lot of people, not because the data is speculative, because it is not. The data is very clear. The uncomfortable part is what it implies about the assets most people in this country are holding right now. I am going to name 5 specific asset categories. I'm going to tell you exactly why the structural environment is turning against them. I'm going to show you what the institutions with real size are doing instead. And I'm going to give you the full case against my own analysis, because if you cannot hold both arguments in your head at the same time, you are not ready to make a decision with your own money. Watch this fully. The first asset. Sounds obvious. The 5th one will surprise most of you. In the last video, I made 3 specific calls. First, I said the Shanghai Gold Exchange physical premium over COMEX would widen beyond $6 per ounce before year-end 2025. It closed December 24th at an $8 premium. That number deserves your full attention. Second, I said the People's Bank of China would not stop its official buying cycle even at prices above $4,000. As of March 2026, the PBOC has now reported 17 consecutive months of purchases. Its official holdings stand at 2,313 tons. The buying did not slow, it accelerated. Third, I said gold would breach $4,000 per ounce in October 2025. It did, on October 8th, for the first time in history. I am not saying that to celebrate. I am saying it because the record matters. The calls are either right or they are wrong. If they are consistently right, the framework behind them deserves your time. If they start being wrong, I will tell you first. Here is the anomaly I want you to sit with before we go further. Gold hit an intraday all-time high of $5,595 per ounce in early March 2026 during the Iran escalation. Since then, price has corrected back toward the $4,900 to $5,000 range. Most Western retail investors looked at that correction and saw weakness. They started asking whether the rally was over. In that same window, the PBOC added 5 tons in March alone. The National Bank of Poland purchased 20 tons in February. India's Reserve Bank added 18 tons in February. The World Gold Council reported that 68% of all central banks plan to increase gold holdings in 2026, up from 62% in 2025. Price pulled back. Sovereign buyers bought more. That is not a glitch. That is information. The question the data needs to answer is this: who is selling into this correction, and why are the entities with the largest balance sheets on the planet treating that selling as an opportunity? That asymmetry is what this entire video is built around. Let me give you the specific numbers driving the macro environment right now. The United States Treasury refinanced $9.2 trillion of maturing debt in fiscal year 2025 alone. That is approximately 25% of the entire national debt rolled over in a single fiscal year. The U.S. Government Accountability Office released a report on April 3rd, 2026, confirming that federal deficits are projected to average over $2 trillion per year through 2036. Debt held by the public as of February 2026 stood at over $31 trillion. Here is the mechanical problem. The weighted average coupon on existing U.S. Treasury notes and bonds stands at 2.99%. New issuance this year carries a weighted average coupon of 4.18%. Every dollar that rolls over gets refinanced at a higher rate. The UBS fixed income desk estimates this rollover dynamic will add $69 billion in annual interest costs just from the bonds maturing through end of 2026. Treasury Secretary Bessent stated publicly on June 30th, 2025, that long-term debt issuance made no economic sense at current rates. His exact framing was that Treasury is, quote, more than one standard deviation above long-term rates. He admitted they missed the window to lock in cheap long-term funding. The U.S. government is now structurally trapped in short-term bill issuance, rolling debt continuously at elevated rates. That is the fiscal engine underneath everything else in this video. Now, add the geopolitical layer. A brief but intense military confrontation between U.S. and Iranian interests occurred in late February 2026. The Strait of Hormuz faced active disruption risk. Oil markets spiked, gold spiked. The confrontation cooled, but the structural geopolitical risk did not. The Middle East instability that sent gold to 5,595 intraday has not resolved. It has been temporarily priced out. Temporary mispricings are where the money is made. The U.S. debt ceiling was raised by $5 trillion to $41.1 trillion in July 2025. Congress and Treasury are heading toward another ceiling confrontation. The pattern since 1960 is that Congress has acted 78 separate times to raise or suspend the limit. The pattern will likely continue. But each episode introduces volatility, and volatility in government borrowing costs is exactly the mechanism that forces capital to reallocate. Price and reality are telling two different stories right now. Let me be specific about what physical markets are doing versus what paper markets are pricing. On December 24th, 2025, physical silver on the Shanghai Gold Exchange closed at $78.49 per ounce. COMEX silver futures were pricing approximately $70.50 at the same moment. That is a premium of over $8 per ounce, not a rounding error, $8. The SGE's AG T plus D contract requires actual physical delivery. COMEX futures are predominantly paper contracts frequently settled in cash or via exchange for physical mechanisms that delay or divert actual metal. When Shanghai bids $8 above New York for the same metal, it means physical buyers in China are more desperate to secure real metal than paper traders in New York are willing to acknowledge. Silver also moved into backwardation in China at the same time those $8 premiums existed. Backwardation means the spot price is higher than futures prices. The market is saying it needs metal now more than it needs it later. That is an acute stress signal. The premium does not lie. Paper can. On gold, the PBOC's reported holdings are 2,313 tons as of March 2026. That is the reported figure. Analysts at multiple commodity desks believe China is buying an additional 200 to 300 tons annually through commercial banks and state enterprises that are not captured in official PBOC disclosures. If that estimate is accurate, the true global central bank demand figure in 2025 was not 1,237 tons. It was potentially 1,500 to 600 tons against annual mine supply of approximately 3,900 tons. That is not a marginal demand story. That is a structural demand story. COMEX gold inventory has been under pressure as well. The flow of physical metal from London and Zurich vaults toward eastern delivery points is a documented phenomenon. When physical metal moves, paper pricing eventually follows. The lag creates the opportunity window. Let me be direct about what is happening mechanically to certain asset prices. Gold is currently trading near $5,000 per ounce. JP Morgan projects it reaching $5,000 by Q4 2026 and sees a path to $6,000 longer term. BlackRock reports gold ETPs now hold over 4,000 tons globally, with holdings rising roughly 25% in 2025, alone to over $650 billion in assets. Those are headline numbers, but here is what the headline misses. Gold's share of global foreign reserves was 12% in 2020. It rose to 15% by end of 2025. The United States holds 8,133 tons. Germany holds 33 tons. Germany holds 3,352 tons. China's official position is 2,313 tons. China's total foreign reserves dwarf those gold holdings. China's gold as a percentage of total reserves still sits at roughly 9.6% as of January 2026. The U.S. holds gold at roughly 68% of reserves. That gap is the story. China and most emerging market central banks are structurally underweight gold relative to Western standards. The reallocation from paper reserves, meaning primarily U.S. Treasuries, to hard assets like gold is not a trade. It is a multi-decade policy shift. China's Treasury holdings peaked at approximately $1.3 trillion. As of mid-2025, they had fallen to $731 billion. That is the lowest since 2009. Those dollars did not disappear. They were redeployed. A significant portion went into gold. Now here is the mechanical reason price does not fully reflect this. Gold is priced primarily in the LBMA London market and on COMEX. Both are Western paper markets. Both allow leverage and synthetic exposure that can temporarily suppress spot prices below where pure physical supply and demand would set them. This is not a conspiracy. It is how futures markets work by design. The leverage that paper markets provide also means that paper selling can temporarily overwhelm physical buying signals. That suppression mechanism is structural. It can persist for extended periods. But when physical delivery demand becomes acute enough, as it did in Shanghai in December 2025, the paper price is eventually forced to converge upward. That is not speculation. That is observable in the data. Now, let me name the 5 things I believe you should stop buying before 2027, and I will walk through why each one sits in a structurally weakening position given everything I just described. Asset 1, long-duration U.S. Treasury bonds. The conventional wisdom is that long-dated treasuries are safe. They are the risk-free benchmark, the store of value for conservative portfolios. Here is the data problem with that story. The U.S. is refinancing pandemic-era debt at what Seeking Alpha's fixed income desk called quadruple the interest rates at which it was originally issued. The UBS Fiscal Analysis projects that if weighted average Treasury yields rise to 5% and hold, net interest costs will reach 17.2% of general government revenues by 2030. That is not a stress scenario. That is a plausible base case if inflation does not cooperate with the Fed's easing trajectory. The comfortable reason long-duration treasuries are underperforming is that yields are high and duration risk is real. The uncomfortable reason is that foreign demand is structurally retreating. Domestic investment funds, meaning money market funds, mutual funds, and hedge funds, were the largest buyers at Treasury auctions as of September 2025. Foreign investors, which once anchored demand, have been stepping back. When the marginal buyer of U.S. government debt shifts from price-insensitive sovereign entities to price-sensitive domestic funds, the risk premium embedded in long-duration bonds has to rise. Higher risk premium means lower prices. Bonds have generated negative real returns during much of 2023 through 2025. The correlation between stocks and bonds has shifted toward positive during market stress. The diversification argument for long treasuries is structurally broken in a high inflation, high deficit regime. Size does not tell you direction. It tells you who controls the speed. The entities with the size to move treasury prices are now sellers, not buyers. Asset 2, overweight U.S. equity index funds and passive allocations. This one requires nuance. I am not telling you to sell all equities. I am telling you that the passive index fund as a no-think wealth-building vehicle is approaching the end of its easiest years. Here is why. The S&P 500's outperformance over 2 decades was built on a specific regime: falling interest rates, expanding multiples, dollar strength, and the U.S. consumer as the engine of global demand. 3 of those 4 conditions have shifted or are shifting. The dollar experienced its steepest annual decline since 2017 and 2025, reflecting fiscal anxiety. Interest rates remain structurally higher than the prior decade. Multiple expansion requires either earnings acceleration or rate compression. Neither is cleanly in place. The uncomfortable reason goes deeper. The passive index vehicle concentrates capital in the largest market cap companies by definition. Those companies are priced for a world that may not persist. When the regime changes, passive investors learn that index diversification does not mean regime diversification. The comfortable reason is that earnings have been resilient. The uncomfortable reason is that the earnings resilience has been built on dollar-denominated global revenues that now face headwinds as the dollar weakens and geopolitical fragmentation accelerates. When the crowd is most certain, the move is almost over. Asset 3, residential real estate and high tax, low migration urban markets. This one is demographic and structural rather than monetary. The wealth transfer I referenced in this video's title is not only financial, it is geographic. Capital and people are moving from high tax, high regulation jurisdictions toward lower cost environments. This is not a political statement. It is a migration data observation. The real estate markets that benefited most from the 2010 to 2021 zero rate environment were concentrated in specific coastal urban corridors. Those markets are now facing three simultaneous headwinds: elevated mortgage rates that suppress new buyer demand, elevated property taxes that suppress net returns for holders, and net population outflows as remote work has permanently altered location economics. The comfortable reason for buying in these markets is that supply is constrained and replacement cost is high. That is true. The uncomfortable reason is that constrained supply with declining demand does not produce rising prices. It produces stagnation and a very illiquid exit when you need one. Asset 4, physical cash held in savings accounts above FD1. See coverage. I want to be careful here because cash has real value in the right context. Emergency funds, short duration liquidity buffers, tactical dry powder. These are legitimate reasons to hold cash. The problem is structural, and it is named in the data clearly. Inflation in the United States ran persistently above the Federal Reserve's 2% target through most of 2023 to 2025. US CP1 as of early 2026 sits at 3.2% according to Bureau of Labor Statistics February data. The federal funds rate has been cut toward 3.50 to 3.75% by December 2025, and the trajectory is toward further easing. When the policy rate is at 3.50% and inflation is at 3.2%, the real return on cash is approximately 0.30% before tax. After tax, it is negative. This is not a temporary condition. This is the mechanism the U.S. Treasury implicitly relies on. Treasury Secretary Bessent's admission that long-term issuance makes no sense at current rates is effectively the government acknowledging that it intends to inflate its way through the debt burden over time, not repay it in real terms. Holding large, idle cash balances in a financial repression environment is not conservative. It is a slow, invisible transfer of purchasing power from savers to the government. That is the wealth transfer the title references. It is happening whether you participate or not. Asset 5, collectibles and non-productive assets purchased at cycle peak valuations. This is the one that will surprise people because it sounds like common sense. But look at where capital flew between 2020 and 2023. High-end watches, fine art, sports memorabilia, vintage cars, certain categories of NFTs before their collapse, rare whiskey, handbag. Speculation. Every one of those categories benefited from the same driver: excess liquidity, zero borrowing costs, and wealthy individuals with asset price inflation creating a wealth effect that flowed into non-productive stores of value. That liquidity regime is over. Real borrowing costs are positive again. The wealth effect from asset price inflation is uneven and uncertain. And collectibles are the most illiquid, most fad-sensitive, most bid-ask spread-punishing asset class you can hold when credit conditions tighten. The comfortable reason people still hold these is that the top end of the market has proven resilient. That is true for rare, institutional-grade pieces. It is not true for the mass of mid-tier collectibles bought between 2020 and 2022. The regime hierarchy is now as follows: hard monetary assets with sovereign demand floors, then productive equity in sectors aligned with the energy and industrial transition, then cash for liquidity purposes, then long duration pay. Promises at the bottom. Collectibles purchased above intrinsic value sit outside the productive capital stack entirely. Let me name the entity with the most consequential position in this regime shift: the People's Bank of China. As of March 2026, the PBOC holds 2,313 tons of gold officially. It has extended its buying streak to 17 consecutive months. Its gold as a percentage of total reserves sits at 9.6%. The U.S. holds gold at 68% of reserves. China has a strategic incentive to close that gap over the next decade. Here is the incentive structure. China holds approximately $731 billion in U.S. Treasuries as of mid-2025, the lowest level since 2009. Every dollar of treasuries it holds is a dollar of exposure to U.S. fiscal decisions, U.S. sanctions risk, and U.S. dollar debasement. The $300 billion in Russian sovereign reserves that were frozen in 2022 taught every non-Western central bank the same lesson simultaneously. Paper reserves held in Western institutions carry political risk that gold held in domestic vaults does not. The PBOC is not buying gold as a trade. It is buying gold as policy. Size does not tell you direction. It tells you who controls the speed. The PBOC controls the speed of gold's structural floor. When price pulls back toward $4,500 to $4,600, sovereign buyers become aggressively active, according to the structural analysis from onlinegold.org's February 2026 research. That sovereign demand floor exists in gold because the PBOC and 40+ other central banks are buying as policy, not as price-sensitive traders. The direction is not guaranteed. The mechanism is documented. There is one price level that will tell you whether the structural thesis is intact or under pressure. Gold at $4,500 per ounce. That is the level identified by multiple sovereign demand analyses as the zone where central bank buying becomes aggressive. It is approximately 10% below current prices, near 5,000. It is not a crash scenario. It is a normal correction in a structural bull market. Bull case of 4,500 holds. The sovereign demand floor is confirmed. The structural thesis of central bank accumulation as policy is intact. JP Morgan's $5,000 Q4 2026 target is the next objective, with 6,000 as the longer-term destination. Silver, which is currently operating at a discount to its historical gold to silver ratio, could see a 30 to 40% repricing as industrial demand from solar photovoltaics, AI infrastructure, and solid-state batteries intersects with constrained supply. Bear case of 4,500 breaks. The Fed pivots hawkish unexpectedly. Real yields spike above 2.5%. Central banks pause purchases as prices fell too fast to absorb tactically. A deep retest of 3,800 to 4,000 becomes plausible. The structural thesis is not destroyed, but the timeline extends significantly. Watch that number. 4,500, not 5,000, not 6,000. The confirmation or denial of the entire framework sits at 4,500. Now, here is the case against everything I just said. Risk 1, a hawkish Fed pivot the Federal Reserve cut rates to 3.50 to 3.75% by December 2025. Markets are pricing further easing into 2026. But if USCP1 reaccelerates above 4% due to tariff pass-through, energy shocks, or renewed fiscal expansion, the Fed could reverse course sharply. Rising real yields historically cool gold's momentum and compress equity risk premiums in a way that could benefit treasuries. Everything I described in this video assumes the easing trajectory continues. If it does not, the near-term outlook for gold and commodities deteriorates meaningfully. Risk 2, dollar strengthening event. The dollar declined steeply in 2025, reinforcing the debasement thesis. But the dollar is still the world's reserve currency. In a global risk-off event, even one driven by U.S. fiscal concerns. Capital historically flows into dollars, initially because dollar-denominated liquidity is the deepest market on Earth. A dollar surge of 10 to 15% from a systemic shock could temporarily overwhelm the gold demand story. The thesis is correct on a 3 to 5 year horizon. It can be very wrong on a 3 to 6 month horizon. Risk 3. China's economy structurally slows if China's property sector delivers a larger than expected deflationary shock and domestic credit contracts sharply. Demand for silver from Chinese industrial applications and demand for gold from Chinese private investors could both decline simultaneously. The Shanghai premiums could compress. Physical demand from the world's largest consumer of both metals could undercut the Eastern pricing premium story significantly. China's economic trajectory is the single largest known uncertainty in this framework. Risk 4. Geopolitical de-escalation. Part of the current premium embedded in gold near 5,000 is a geopolitical risk component from Middle East tensions and the U.S.-Iran confrontation. If a meaningful diplomatic resolution occurs and geopolitical risk premiums compress, gold could correct 10 to 15% quickly, even with the structural demand intact. The structural demand sets a floor. It does not prevent corrections from elevated geopolitical premiums returning toward historical baselines. These risks have the same weight as everything else I said. They are not afterthoughts. They are the reasons no one should allocate a single dollar based on any one analyst's framework alone. Here are 5 structural facts that remain intact regardless of where price closes today, tomorrow, or next month. Fact 1. The U.S. federal deficit is projected to average over $2 trillion per year through 2036. The GAO published this on April 3, 2026. This is not a projection from a gold bug. It is from the official government accountability body. The structural deficit is not a cycle. It is the baseline. Fact 2. Central banks purchased over 1,200 tons of gold in 2025, the third consecutive year above 1,000 tons. The buying is distributed across more than 40 institutions, which makes it more stable and harder to disrupt than if it were concentrated in 1 or 2 buyers. The 2025 total was triple the pre-2022 average annual rate. Fact 3. Silver faces a structural supply deficit entering its 5th consecutive year. Approximately 58% of global silver demand now comes from industrial applications. Photovoltaic consumption from solar panels reached all-time highs in 2025. Solid-state battery development represents an unquantified but potentially massive additional demand vector. Supply deficits do not resolve quickly. Mine development timelines are measured in decades. Fact 4. The BRICS alliance controlled approximately 50% of global gold production as of December 2025. The architecture for dollar alternative settlement systems, including BRICS Pay, is being built incrementally. The infrastructure for non-dollar trade settlement is not complete, but it is not theoretical. It is in construction. Fact 5. Russell Napier, the institutional economic historian and author of Anatomy of the Bear, has argued for several years that we have entered a new era of financial repression, where governments will suppress real interest rates below inflation for an extended period to erode debt burdens without explicit default. That process is already underway. It does not require a crisis to continue. It requires only that inflation stay above the policy rate. That condition has been in place more often than not since 2021. The open unanswered question that this data does not yet resolve is this: at what point does the pace of central bank gold accumulation become self-defeating, meaning price rises so fast that sovereign buyers cannot absorb further tranches without destabilizing global currency markets? We do not yet know where that ceiling is. No one does. Let me give you the summary quickly. Long-duration U.S. Treasuries face a structural headwind from rising refinancing costs, declining foreign demand, and a fiscal trajectory that requires either financial repression or inflation to resolve. Long-duration paper promises in a debasement regime are not conservative holdings. They are slow transfers of wealth from savers to sovereigns. Passive equity index fund overweights in a dollar weakening. Multiple compressing regime face the risk of a decade of flat real returns, the same outcome Japan experienced between 1990 and 2010 after its own debt-fueled boom. High tax, low migration urban real estate is facing demographic headwinds that monetary policy cannot reverse. Large idle cash positions in a financial repression environment are being taxed invisibly through inflation every single month. Collectibles and non-productive assets purchased at cycle peak liquidity conditions face both valuation compression and severe illiquidity risk when the bid disappears. The data is pointing in one direction. The entities with the largest balance sheets on Earth are moving from paper to hard assets, from dollar exposure to non-sovereign stores of value, and from Western pricing benchmarks to Eastern physical demand. Follow them to X right now. The handle is Stanley Druckenmiller. That is where I post real-time updates when a level is tested, when sovereign data drops, and when the framework changes. The urgency is real because the 4,500 level in gold could be tested in any session. You need to know whether it held or broke before the next trading day gives you a reaction to react to. The premium is repricing in real time. The sovereign floor is being established in real time. The fiscal deterioration is compounding in real time. The window to position ahead of the Western consensus does not stay open indefinitely. Don't follow the crowd. Follow the data. Stanley Druckenmiller out.